Most of you feel overwhelmed when trying to mark every level of liquidity on the chart, and many don't even know what liquidity actually is. That was my case until I managed to sort it all out. If you stick with me until the end of this video, you'll learn everything there is to know about liquidity. So, what is liquidity? Liquidity refers to the areas or levels where business transactions occurred previously. Institutions purchase at a specific price level, and retail traders often take advantage of this institutional activity. Our main objective is to identify where the stop-loss orders of these retail traders are located. In the given example, price is purchased at a demand level. We are not focusing on why the purchase occurred, but rather where retail traders might place their stop-loss orders. These stop losses are typically placed at nearby swings, which is where liquidity resides. So, what does this mean for traders? By knowing where these stop losses are, we can anticipate where liquidity is pooled and where price is likely to react. First type of liquidity we're going to cover is support and resistance liquidity, equal highs and equal lows. Price finds resistance at a specific level, indicating that institutions sold at this level. Retail traders might have joined this move, making this level a magnet for future price movement. When price reaches a resistance level, it means institutions have decided to sell at this point. Retail traders might see this as an opportunity to sell as well, contributing to the liquidity pool at this level. The same logic applies to support levels where buying occurs. Price encounters resistance and is likely to break through this level in the future. When price consistently finds resistance at a certain level, it creates what we call equal highs. These equal highs act as a magnet, attracting price to come back and break through eventually. So next, we have trendline liquidity. Retail traders often use trend lines to make trading decisions. Liquidity rests below the trend line, attracting price towards it. When many traders are using trend lines, it means there is a concentration of stop losses below these lines. This concentration creates a pool of liquidity that price tends to be drawn towards. Price rejects from the trend line and is drawn back to it. When price approaches a trend line, it often rejects, creating a bounce. However, this bounce is temporary as the liquidity below the trend line acts as a magnet, pulling price back down. So next up is FTB, or failed to break liquidity. When price approaches and rejects from a supply level, retail traders might join the move. Their stop losses are placed above the swing, creating liquidity. When price fails to break a supply level, it suggests that there are strong sell orders at that level. Retail traders who join this move place their stop losses just above the recent high, adding to the liquidity pool. A supply level causes an aggressive reaction, forming liquidity to be absorbed later. When price reacts aggressively from a supply level, it creates a clear swing high. The area above this swing high becomes a target for liquidity. To understand where liquidity is resting, always look to the left of the chart to see past price actions. Past price actions give us clues about where significant transactions have occurred. These areas are likely to attract price again in the future. If a supply level caused a significant price drop, it indicates strong sell orders. When price returns to this level, the previous sell orders may be depleted, leading to a likely break through the level. When price returns to a level where it previously reacted strongly, the orders that caused the reaction may no longer be present. This absence of orders makes it easier for price to break through. Next up we have FTC, or failed to close liquidity. This liquidity type is characterized by the candle not closing below a range but wicking through it. This level becomes a magnet for price. When a candle wicks through a level but does not close beyond it, it indicates a temporary breach of that level. This creates a trap where liquidity is pooled. Price breaks through a level but then returns, forming a trap and absorbing liquidity. When price wicks through a level and returns, it traps traders who anticipated a breakout. These trapped traders' stop losses add to the liquidity pool. So what is the primary function of liquidity? Liquidity attracts price over time. Price may continue the trend or reverse, forming a range and indicating a trap. This trap absorbs the stop losses of traders who incorrectly anticipated a breakout. Liquidity acts like a magnet, pulling price towards it. When price reaches a liquidity pool, it either absorbs the liquidity and continues in the same direction, or reverses, forming a trap. Buyers were interested in purchasing an asset at the demand zone. Price reacted from this order block, shooting up and breaking structure. Now, when price returns to this level, it's more likely to break through instead of rejecting again. Why? Because there might not be enough buy orders in this demand order block. Price broke through this level, but then came back into the range, forming a trap. Anyone who tried to sell during the initial breakout got trapped, and those who bought at that level had their stop losses hit. So now let's talk about inducement. What is inducement? Inducement occurs when price approaches a level of interest but doesn't reach it, enticing traders to enter positions prematurely. This premature entry creates additional liquidity. Inducement is a tactic used to lure traders into positions before the price reaches the actual point of interest. This adds more liquidity to the market. Price reacts near a point of interest, forming liquidity to induce traders before reaching the actual point of interest and reacting. When price gets close to a significant level but doesn't quite reach it, traders might be induced to enter trades early. This premature action creates liquidity that can be targeted later. So how can you trade liquidity and inducement? So first, you want to locate the liquidity. In this case, here is your liquidity. Recognize the areas where liquidity is likely to be pooled based on price action patterns like wicks, swings, and trend lines. And then, you need to find a point of interest. Identify the order block or level where price is likely to react. Wait for inducement. Price should run on liquidity and reach the point of interest. Be patient and wait for price to approach these identified levels. Inducement often occurs just before price reaches the actual point of interest, creating additional liquidity. So, let's talk about inducement secrets. Use Fibonacci retracement levels, 0, 25, 50, 75, 100% to locate inducement zones. These levels help in identifying the areas where price is likely to induce traders into positions. Inducement should ideally occur around the 50% level. This ensures that the reaction happens near the extremes, providing better trade opportunities. The 50% retracement level often acts as a midpoint where traders are induced into taking positions before price reaches the actual point of interest. As you can see here, price hits the 50% level, returns to the point of interest, and provides a buy opportunity. When price retraces to the 50% level and then moves towards the actual point of interest, it creates a more predictable and reliable trading opportunity. If you've made it this far, don't forget to hit that like button and subscribe.